You do not fail because you are unlucky. You fail because the timing was engineered to break people like you on purpose. And if you have spent the last few years investing blindly, starting businesses that never found traction, or grinding at a job that refuses to promote you, here is the part nobody wants to say out loud. The world is not punishing random mistakes. It is cycling losses through the exact people who can least afford to lose. This is not financial advice. This is financial education. In 2026, money is doing something cruel. It is rewarding speed and punishing delay, but the system sells you the opposite story. It tells you to study for a decade, to buy the safe thing, to stay employed, to wait for interest rates to magically fix your life. Meanwhile, the real operators are already adapting to the new math of automation, housing, and wealth concentration. If you have been watching the stock market climb while your real life feels smaller every month, you are not imagining the disconnect. You are watching a cycle in real time. Here is what you will learn today. First, how economic cycles can be treated like schedules, not mysteries. Second, why your cash decisions are being quietly dragged by central banks and inflation dynamics that never fully reverse. Third, why AI is not just changing jobs, it is changing entire industries, and it is doing it faster than your confidence can keep up. Fourth, where the profit windows are shifting for 2026 and beyond, and why the old paths you were taught are becoming traps. And finally, what you can do that is not gambling, not fantasy, and not manifest it. You need a strategy for timing, selection, and survival because the next cycle will not pause for your comfort. Let's start with the uncomfortable idea that your fate is not random. In the West, people tried to formalize this with economic cycle models that go back more than a century, and in older Eastern traditions they describe timing patterns in language that sounds like superstition until you test it against real markets. Whether you call it cycles or fate, the practical takeaway is the same. When the period turns bad, actions that used to work become expensive and dangerous. When the period turns good, actions that look risky become the ones that print money for people who are ready. You have felt this in your own life, even if you did not know how to name it. Remember the last time you were confident about something, then the world changed and suddenly every assumption collapsed. You were not just unlucky, you were acting in the wrong phase. Markets do not run on your hopes, they run on liquidity, credit conditions, consumer stress, corporate earnings, and policy decisions that are made years before you notice. Now picture this: a person in their early 30s. Let's call him David. David is a nurse, or a teacher, or a warehouse lead, someone stable enough to feel safe. He does not party, he does not gamble, he works, he saves, and he tries to invest like a responsible adult. In 2021, he hears that the future is online, that AI is inevitable, that the best time to start was always now. So he pours money into a couple of speculative funds, maybe a startup, maybe a side hustle with high upside. He also takes on some debt because he wants to move faster than his peers. Then interest rates rise, not in a dramatic movie scene way, but in the slow, suffocating way that makes monthly payments impossible. His rent goes up faster than his wage. Groceries go up again. Insurance jumps. And even if the headline inflation number falls later, the damage to his purchasing power is already locked in. Since 2020, many Americans have watched their real earnings buy fewer necessities. Their salary did not become wealth. It became a smaller version of what it used to be. David tries to pivot. He cuts expenses. He delays retirement contributions. He sells what he can. But the timing is wrong. He is selling assets in the downturn, buying in the peak, and paying for mistakes with the only currency he has: time. And the worst part is that none of this feels like a cycle. It feels like punishment. It feels like I worked hard and still got robbed. That is the emotional trap the system depends on. People think the outcome is personal when the driver is structural timing, and here is the cliff you need to see coming. Once you start looking at cycles, you stop blaming yourself for being human, and you start blaming the rules that were written to transfer wealth from people like David to people who already had capital. In every cycle, there are winners with cash and winners with leverage, and there are losers who have to sell their way out. The reason this happens is not magic, it is math. When the economy is in a rough phase, everything looks cheap. That is when people with cash can buy productive assets at prices that assume worse than reality. It is also when startups and new businesses can gain customers because desperation drives price sensitivity, and the market is forced to innovate. But the trap is that most people do not have cash. They have credit cards, they have a fragile emergency fund, and they have a job that may be next to be automated. They cannot wait for the trough. They panic because they need survival today. When the economy enters prosperity, prices rise and everything looks safe. This is when the public gets loud. This is when influencers tell you the easy path is the one you are already on, and they make it sound like the only reason you are not rich is because you are not motivated enough. This is also when valuation grows disconnected from fundamentals. In that phase, people with leverage can borrow at still manageable costs, buy assets, and inflate their wealth. People without leverage are trapped paying higher prices without higher income. It is not just wealth transfer. It is income strangulation. Then comes the shock phase. Panic arrives, liquidity vanishes, everyone wants to sell at once. If you do not have reserves, you cannot choose. You become forced into the market at the worst time. Your strategy becomes survival trading, and that is how the system manufactures casualties. In the last 2 decades, you can point to multiple moments where the pattern repeated, spikes of optimism, then violent repricing. The dot-com era ended with global fear. The financial crisis followed the same arc with a different cause. After 2012, a long stretch of recovery fueled real estate and risk assets for those who held through, while those who entered late were left holding the bag. The trade tensions and geopolitical uncertainty around the late 2010s created another drag. And in 2020, the world shut down, markets dropped, policy responded, and then the money chase resumed in a new shape. But you might be thinking, fine, cycles exist. Everyone knows that. Here is where it gets darker, because cycles are not just about market prices. They are about the behavior of banks, central banks, and your actual purchasing power. In 2022 and 2023, the Fed raised rates aggressively. The point was to slow demand and fight inflation. The effect on normal people was immediate and painful. Higher rates mean higher mortgage costs. It also means higher credit costs, slower hiring, and increased risk for companies with heavy debt. Meanwhile, inflation did not simply disappear. Even when it came down on paper, the prices of housing, food, utilities, and insurance remained elevated enough to make life feel permanently more expensive. This is where ordinary people get lied to. The headlines suggest stabilization. Your bank account tells a different story. The purchasing power you gained during lower inflation never fully returned for many people because wages adjust slowly and assets adjust differently. Housing and healthcare prices are sticky. Insurance markets harden after climate-driven claims. So the inflation story is not a line graph. It is a long-term erosion that keeps doing damage under calmer numbers. And while your purchasing power is eroding, wealth concentration is doing the opposite. In 2026, the top of society owns an increasing share of financial assets. That matters because in a risk-on market, asset prices rise, and asset owners get richer without working any harder. While you pay higher bills, they receive capital gains. While you are trying to hold on to stability, they rebalance into more opportunities and gain leverage at favorable terms. Now insert the third force, AI. AI in 2026 is not a futuristic concept. It is a productivity tool that companies use to reduce labor cost, accelerate output, and avoid paying for roles that can be automated. Some of the loudest advice from 2020 was, learn to code. That advice has aged like milk. Not because coding is worthless, but because AI can code faster than many human teams and can integrate itself into workflows without waiting for someone to become fully trained. So the job loss story is not just about people being replaced one for one, it is about entire middle layers being removed. The middle class ladder has been thinning. The roles that were once stable, like content production, basic legal research, certain design work, routine customer service, and many analytical tasks, are being compressed. A small team now does what used to take dozens. That changes the economic cycle for workers. During downturns, there are fewer soft landings because the job market is no longer structured to absorb people. Here is a micro story that is painfully common. Imagine a mid-sized marketing firm in the United States. It had a team of writers, editors, and designers. Then it adopts an AI workflow. The first time it saves time, it feels like a minor upgrade. The second time, it saves money. The third time, it saves headcount. Within a year, the firm keeps senior managers to oversee outputs and to enforce brand compliance, but it cuts the junior ranks. The work gets produced faster, often better, and revisions happen instantly instead of over days. The firm does not fail. It wins. It wins because cost structure changes. The employee who loses the job does not get to say, "But I was loyal." Loyalty does not pay rent when the role is obsolete. Now look at the real-world mechanism. When companies cut labor and increase throughput, they can improve earnings even in uncertain markets. That feeds stock prices. Meanwhile, the displaced worker faces wage stagnation or unemployment. That is why the stock market can look strong while your life feels like it is sliding. The market is rewarding efficiency and capital. You are living the human cost of that efficiency. And now the cliffhanger into the next truth, because if AI changes labor, housing changes stability, and central banks change liquidity, then the next cycle will not reward your old plan. It will punish it harder than you expect. You will feel like you are doing everything right and still losing. That is not your fault, it is the system shifting under your feet. So let's talk about timing windows for making money in a way that is not pure gambling. The most honest way to frame it is this: you do not choose one forever strategy. You choose a strategy for a phase. You select bets that survive harsh liquidity conditions, and you lean into opportunities when the risk premium is finally justified again. In 2026, many of the easy money narratives are being exposed as illusions. Passive income myths are the modern version of get-rich prayers. Social media sells the dream of being rich without work. But most people are one emergency away from financial collapse because their monthly obligations were built on unstable assumptions. The emergency is usually medical, or job loss, or a housing reset, or a climate-driven insurance renewal shock. Then the passive lifestyle becomes debt. At the same time, institutional players are repositioning their bets. In crypto, for example, the promise was decentralization and independence from the banking system. In 2026, the reality is regulation, custodianship, and institutional dominance. More of the market structure belongs to large firms. Retail investors often face worse execution and more volatility. That does not mean crypto is meaningless, but it does mean you are not the hero of the story. You are often the liquidity provider. Now, the big question: if the forces are real, where does profit concentrate next? In many economic models and in observed industrial cycles, profits cluster around themes that match the dominant time behavior of society: speed, connectivity, energy, consumer attention, and automation. In plain language, that means industries that move fast, process information instantly, and can scale without proportional headcount. That is why internet-connected services keep reappearing after downturns. When economic conditions worsen, consumer attention does not vanish. It moves. People shop online more. They compare prices. They rely on digital services to reduce friction. Then when conditions improve, online demand expands faster than traditional models. AI strengthens this. The companies that win are the ones that treat AI as infrastructure, not as a novelty. They use it to write, design, analyze, automate customer support, generate content at scale, and improve product cycles. That creates a different kind of economy, one that rewards operators who can manage systems and markets quickly. Here is where you need to be precise. Not every online business makes money. A lot of them burn cash because they rely on attention without retention. But the ones that survive are the ones that either capture a recurring demand stream or they provide tools that reduce cost for other businesses. That brings us to a market reality you cannot ignore. If AI can replace a writer, it can also replace a lot of entry-level service work around writing, so the opportunity moves up the stack. It is not just about making content, it is about being the operator who understands distribution, branding, data, conversion, and workflow design. And if you think that sounds vague, good, it should make you uncomfortable. Vague advice is what got you stuck, but the underlying mechanism is not vague at all. Businesses need growth and efficiency. AI changes the cost curve. The operators who can manage the new cost curve will capture demand. Now let's connect that to the housing crisis, because the cruel part is that even if you find a business or a job in the next cycle, housing still decides whether you can breathe. Across the United States, the United Kingdom, Canada, Australia, and parts of Europe, housing affordability has detached from wages. That does not mean prices only go up forever. It means the relationship between income and ownership got broken. For a generation, renting is becoming a long-term default, and renting is not wealth building. Renting is recurring cost. It reduces risk-taking capacity. It makes people choose jobs that pay reliably instead of jobs that build leverage. So the housing problem is not just a lifestyle issue, it is an economic trap that slows your ability to participate in the cycles. If you cannot save, you cannot buy into the trough. If you cannot buy into the trough, you get locked into the peak. That is how many people lose for decades without ever realizing they are stuck in a timing cycle. And here is the part nobody wants to connect. Climate disruptions are making housing even more fragile through insurance collapse and migration costs. When insurance rates rise, homeowners' budgets tighten. When it becomes hard to insure certain areas, property values can wobble and cash flow expectations change. That adds another layer of volatility to an already unstable affordability system. Now, you might be thinking, so what do? I cannot control interest rates. I cannot control AI. I cannot control housing. Correct. That is the correct reaction. The next step is what most people refuse to do: build a plan for survival that still lets you move when opportunity arrives. Let's talk about what survival looks like in the next phase. Survival is not hiding under your bed. Survival is cash flow protection. It is reducing forced selling. It is avoiding leverage that turns a normal downturn into bankruptcy. And yes, bankruptcy still happens even when the news sounds calm. The most dangerous period is not necessarily when the market crashes. It is when the market looks fine, but your personal finances are already broken. You lose your job, your savings are gone, your landlord raises rent, your credit card debt grows. That is a slow emergency until suddenly you are out of options. This is why timing matters. If you understand the cycle, you recognize what phase you are in. If you are in a phase where liquidity is tight and labor is being compressed by AI, your job is to avoid being forced into bad decisions. And if you are in a phase where credit loosens and productivity gains widen corporate profits, you lean into building capacity, not chasing hype. Now we come back to the spiritual sounding idea, but we translate it into economic reality. The idea is that you borrow momentum, you collaborate with people who are ahead of the curve. In business language, that means partnerships, hiring smart operators, acquiring distribution, and aligning with organizations that have capital and direction. You do not have to be lucky. You have to be connected to the right momentum. Think about how management companies work in entertainment. A star can explode in popularity and then fade.